In recent years, a narrative has been gaining traction within China's automotive industry that international joint venture brands seems to be losing ground to China's homegrown car manufacturers. A telling example can be found in a recent video.
In 2023, Acura, Honda's luxury arm, withdrew from the Chinese market. Their exit was notable, as since their entry in 2006, they consistently faced sales challenges, despite vigorous marketing campaigns. Many insiders speculate that Acura's departure, in light of the increasing dominance of local brands and emerging automotive startups, might be a harbinger for other foreign brands. If these international joint ventures don't pivot swiftly, Acura might just be the tip of the iceberg.
Further evidence, as detailed in this article, joins to several joint ventures foreign brands, including Suzuki and Mitsubishi, that have left the Chinese market. Even powerhouse Japanese brands like Toyota, Honda, and Nissan are seeing sales dips in China. Yet, it may be presumptuous to say that this shift indicates a sweeping victory for domestic brands. Interestingly, many of these same brands retreating from China are thriving in other countries. Consider Honda. Despite a 25% year-on-year decrease in their Chinese car sales this past August, they experienced a 57% sales spike in the US. Globally, they even ramped up their production by 27,171 vehicles, propelling their US stock price to unprecedented heights. Similarly, Toyota recently achieved a production milestone of over 18 million units globally, even as their China numbers indicate a decline. This evolving dynamic prompts a pivotal inquiry. Are these global brands genuinely faltering in China, or are they strategically pivoting to other promising markets? Their significant growth in regions like the US suggests a keen ability to re-strategize based on global market dynamics. Consequently, this isn't just about a contest of supremacy between Chinese and international brands. It underscores a broader reflection on China's market appeal and the inherent challenges of doing business there. Observing Chinese car brands, one will note their aggressive expansion in the global arena, scouting new opportunities and markets. Take BYD as an example. This domestic electric vehicle EV frontrunner has ventured into the Japanese market, a notoriously challenging terrain for Chinese brands. However, rumors and leaked footage suggest a considerable stockpile of unsold inventory within China, casting doubts on BYD's actual sales figures. Could it be that BYD isn't as successful in its home turf as advertised, thereby driving its activity overseas? Zooming out, BYD's globalization strategy aligns with the Chinese government's targets for economic growth and foreign reserves. But the journey isn't a cakewalk. The EU has recently launched an investigation into China's electric vehicle subsidies, a probe that directly hampers BYD's European aspirations. Additionally, on a global scale, both BYD and other Chinese brands encounter myriad challenges, from high US tariffs, Japanese skepticism over battery technology, to India's outright rejection of BYD's manufacturing proposals. In Southeast Asia, BYD finds itself in direct competition with Japanese and Korean auto giants. Only in Africa and Russia, where transactions are done in Chinese yuan, does BYD have an advantage. The European market is therefore significant to BYD. Thanks to the Chinese government's export subsidy policy, Chinese electric cars are priced nearly 20% lower in Europe. Coupled with eligibility for European subsidies, Chinese EVs now hold an 8% share of the European market. However, this advantage may soon evaporate. Should anti-dumping and counter-subsidy investigations conclude against Chinese manufacturers' favor, Chinese EVs could face additional tariffs ranging from 10% to 15% and be excluded from EU subsidies. Other nations might follow suit, further complicating BYD's global expansion and threatening China's foreign exchange earnings. Concurrently, the Chinese Communist Party's strategic position in the Taiwan Strait and pro-Russia stance may be impacted, adding layers of complexity to President Xi Jinping's grand strategy of national resurgence. On September 13th, after the news broke of EU's anti-dumping investigation, Hong Kong's new energy sector took a significant hit. Notably, stock prices of BYD, Xpeng, NIO, and Li Auto plummeted. Foreign investors exhibited growing pessimism about China's economic future, leading to frequent sell-offs, especially shares of Battery Titan, KATL, Contemporary, and Perex Technology Co. Limited. In the global automobile sphere, China's market is distinct. Not long ago, in 2017, the Chinese auto industry was booming, boasting rising sales annually. Fast forward to today, when economic challenges and a shrinking middle class purchasing power have impacted sales, affecting even big names in the industry. Take BYD, for instance. Once the beacon of hope in China's auto industry, it registered a commendable 80% year-on-year growth this year. Yet, even this figure doesn't shield them from the reality of domestic market saturation. Their ambitious annual target of selling 3 million vehicles seems to be a distant dream, as halfway into the year, they've barely crossed the 50% mark. And the prognosis isn't great, with an anticipated deficit of 500,000 vehicles by year end. What's truly puzzling is that these underwhelming numbers persist despite significant governmental backing. In cities like Shanghai, consumers are incentivized with free green licenses for electric vehicles. These licenses, potentially valued at 100,000 yuan, indirectly subsidize the consumer. Yet, even with such tailwinds, BYD finds the annual target elusive, primarily due to fierce competition. When stacked against giants like Tesla in the electric vehicle arena, BYD's sales seems modest. A comparison of sales for the second quarter reveals BYD's 352,000 units trailing Tesla's 466,000. And it's not just Tesla. When you peek into the hybrid vehicle segment, BYD's lag against Toyota is palatable, with a gap of a staggering 336,000 units from January to August. Brands like Volkswagen and Toyota, while not yet fully invested in new energy vehicles, loom large on the horizon. In addition, the public is skeptical about BYD's plug-in hybrids. Many users have reported higher than promised fuel and power consumption, often leading them to treat these vehicles like regular gasoline vehicles. This consumer sentiment, coupled with the inadequate charging infrastructure in many areas, sees many gravitate towards alternatives like Toyota's hybrid models. Chinese policymakers are aware of these market challenges. There's growing acknowledgement among them about the limited fuel efficiency of plug-in hybrids in comparison to other hybrids. This might hint at potentially policy shift, possibly diminishing support for plug-in hybrid technology, making the road ahead even rockier for BYD against formidable competitors like Toyota. Let's not forget Toyota's overarching strategy either. A mammoth 95% of their sales come from hybrids, achieved without any subsidies. Their electric vehicle and plug-in only contribute 5% of their total sales. Yet Toyota has been vocal about its plan to prioritize electric vehicles, with a target to launch a full-fledged EV by 2027 that boasts a quick 10-minute charge and an impressive 1,200 kilometers range. Starting with their BZ4X model, which has already made its mark with 5,836 units sold in August, Toyota's electric ambitions are clear. Volkswagen isn't resting on its laurels either. CEO Oliver Bloom is confident about their prospective leading role in China's new energy vehicle market. Pioneering market analyst even foresees a future where traditional giants like Toyota and Volkswagen alongside Tesla will likely dominate the Chinese landscape. And what about China's homegrown brands? Although enjoying substantial governmental subsidies, profitability remains elusive. Only a select few boast respectable profit margins, and these are predominantly buoyed by subsidies. To put it into perspective, in 2022, industry frontrunners like BYD and SAIC's annual profit barely touched 10 billion yuan. Astonishingly, a whopping 60% of BYD's net profit originated from subsidies. Meanwhile, emerging players like NIO, Xpeng, Li Auto, and Leapmotor are still navigating losses, even after accounting for these subsidies. In such a scenario, market share might be a misleading metric of success because it profitability remains a challenge for every vehicle sold, sustainable growth appears impossible. On the international automobile scene, BYD still lags behind global giants like Tesla, Toyota, and Volkswagen. In 2023 up to June 30th, BYD sold roughly 2.5 million units, while Tesla delivered about 1.6 million units. To put this in perspective, Toyota, the global juggernaut in car sales, dispatched around 9.1 million units in the same period, almost 3.7 times BYD's numbers. These statistics underscore that, despite the electric vehicle market's rapid surge, traditional automotive powerhouses like Toyota still dominate. Volkswagen, which hold the second spot globally, also displayed commendable sales, beating BYD by a margin of 260,000 units in just the first 8 months, solidifying its top spot in the Chinese market. Globally, BYD lags behind Tesla in manufacturing and cost efficiency. Tesla is investing more into automation in its production. The question looms, can diligent Chinese workers outpace machines? If the US persists in tech embargoes against China, the latter might find itself overshadowed in the future auto industry, marking an end to its dominance. From a demand standpoint, China's per capita car ownership is notably below the global norm. For context, the US boasts a car ownership rate of 0.9 per person. Japan 0.7, and most European nations hover over 0.6. Countries like Russia, Brazil, and Mexico approximate around 0.5 vehicles per person. However, China's rate is a mere 0.2 vehicles. This implies that to stimulate car sales in China, prices must need to be reduced, which would further squeeze profit margins for companies therein. In the backdrop of mounting tensions within the First Island chain region, especially Taiwan, Japan, and the Philippines, joint venture brands could be sailing into choppy waters.
Honda seems to be reassessing its footing in China, eyeing other markets that promise brighter prospects for growth.
Brands such as GAC, Mitsubishi, Chang'an, and Mazda are setting their sights abroad, with Honda's US sales surging past 110,000 units in July and maintaining an upward trajectory in Europe, Japan, and Southeast Asia. Even a complete pullout from China might just be a drop in the bucket concerning their overall profitability. Such sentiments are underscored by Honda's stark 33% sales slump in China in the past August, leading some to speculate that a strategic retreat from the country could be on the horizon. Many enterprises favor markets that offer a smoother path to financial success than China. In an era where vehicles made in China could encounter stiff tariffs on the global stage, a plethora of businesses are contemplating broadening their horizons to areas such as Mexico, Southeast Asia, India, Europe, the US, or even traditionally challenging Japanese market. South Korea's Hyundai Motor Group emerged as a textbook example. In the early 2000s, Hyundai ventured into the Chinese market, rapidly reaching significant milestones. By 2016, they hit a peak in sales with a staggering 1.1 million vehicles being sold. Yet by 2022, due to geopolitical tensions, evolving domestic policies, and intensified competition, their sales took a sharp nosedive to a mere 250,000 vehicles. This drastic downturn also saw a reduction of the production base in China, halving them from 6 to 3, and leading to facility transfer in places like Chongqing and their flagship Beijing factory. But Hyundai's success story in India and Southeast Asia have been impressive. In 2022 alone, Hyundai recorded sales of over 550,000 vehicles in India, capturing a market share of 14.5%. Coupled with their subsidiary Kia, the conglomerate's Indian market share surged to 21%, trailing only behind the Japanese-Indian giant Maruti Suzuki. Given their trajectory touting India as potentially the world's third largest automotive market by 2030, Hyundai holds promising prospects in the subcontinent. In Vietnam, Hyundai's alliance with Kia has catalyzed a dominant position, clinching a 31% market share. In Indonesia, Hyundai's influence is expanding, registering robust sales figures. Considering that many brands succeed globally but struggle in China, it begs the question, is the allure of the Chinese market genuine, offering equitable opportunities to all? Or is it perhaps a mirage of prosperity, glittering on the outside but fraught with hidden intricacies within?